The next Bank of Canada rate announcement and monetary policy report is April 10th, just a few weeks away. And I hope that they finally announce that not only are we in a recession, but we have been for a while. I have a very unpopular opinion that the Bank of Canada isn't looking at the new data the way that they should be, and that rates could be coming down a lot faster than we originally thought. But the headlines of February inflation slowing down shouldn't be a surprise. Businesses are not doing well and consumer debt is rising at a pretty quick rate. The economy is cooling a lot quicker than the Bank of Canada recognizes or cares to mention.
You never thought to mention that?
The expectations are for a 0.75% rate cut this year, but given how quickly things are worsening, a 1.5% cut shouldn't be off the table, but let me show you the data that I'm talking about. The insolvency data is insanely bad. Business insolvencies spiked in January to the highest levels that we've seen since 2006. The corporate bankruptcy numbers were almost off the chart. And keep in mind, all of these companies have employees, contractors, and other businesses that depend on them. But now we're seeing it in the labor market. Private sector payroll has declined over the past 6 months. This is the first time since the pandemic lockdowns, and before that, the financial crisis. If you're still thinking that we aren't in a recession, let's look at GDP. Now, we've also seen 5 straight quarters of declining per capita GDP, and it's falling at an annual rate that has always been recessionary in the past. That means all the growth in the headline GDP is coming from growing the population compared to growing the output. All right, quick pause on this video. Listen, before I say anything, this isn't coming from me, this is coming from the entire team. We need more subs. A lot of our viewers are still not subscribed, so please like, share, and comment below on the type of content that you'd like to see next. Canada is going to reduce the number of international study permits by 35%, and as we continue to cut immigration, that's going to show up on our GDP data, making it even lower over the next few years. Mortgage delinquencies are rising quickly, but they aren't at all-time highs, but they are moving quick. The number of delinquent mortgages rose by 500 nationally in December. That's not a massive move, but it still represents the highest monthly increase since April and May of 2020. This data changes week to week and month to month, but look at how these rate expectations changed over just 9 weeks. Things are trending and signaling a recession, from consumer proposals to credit card debt climbing over 13% versus last year. Businesses are struggling and home prices keep rising. Rates have to come down, and they're showing signs of coming down faster than what we expected, but the economy might be in a much worse position by the time we see lower rates.